Pecking order theory. Pecking order theory provides a preference order in which finance has to be raised. This is mainly on the focus of going from low cost to high cost. Number 1. Internally generated funds, retained earnings. This finance has to be used first. These are internally generated, hence don't have to search for other investors. There is no issue cost as well. Number 2. Debt. Next in order comes debt, because they are cheaper than equity and easier to gain access to compared to raising equity finance. The interest on debt is tax deductible as well. There is moderate issue cost. Number 3. Equity. Last in the order is equity finance. Equity investors are harder to find. Higher cost of capital and issue cost. Summary of gearing theories. Number 1. Traditional theory. A. Net effect as gearing increases. WACC is U-shaped. B. Impact on WACC. At optimal point, WACC is minimized. C. Optimal finance method. Find and maintain optimum gearing ratio. Number 2. No tax. A. Net effect as gearing increases. Cheaper debt is equal to increase in KE. B. Impact on WACC. WACC is constant. C. Optimal finance method. Any choice of finance can be used. It is irrelevant. Number 3. With tax. A. Net effect as gearing increases. Cheaper debt is greater than increase in KE. B. Impact on WACC. WACC falls. C. Optimal finance method. 99.9% debt. Number 4. Pecking order theory. A. Net effect as gearing increases. No theorized process. B. Impact on WACC. No theorized process. C. Optimal finance method. First internally generated, then debt, then equity. CAPM and gearing risk. Using a CAPM model for investment appraisal involves the consideration of risk factor when investing into a project of different risk profile. It must be carefully understood that when beta factors are considered, not only should it represent the business risk, but the financial risk must also be considered. More on betas. There are 2 types of risk an investor will have to face. Business risk, resulting from business activities. Financial risk, caused from level of gearing. The business risk alone will be represented by asset beta. Equity beta represents both business risk plus financial risk of a company. Application of betas in project appraisal. Suppose a company decides to invest in a project of different risk profile. After the investment, that new risk profile is also part of our already existing risk profile. This means the change in risk profile overall results in change in overall cost of capital, and hence the required return from investors. The application of betas in project appraisal is to incorporate this different risk profile into the existing one and find new total risk profile so that based on the new beta value, cost of equity can be found out. Steps involved in calculation. The common scenario is that the financial structure of our company and current equity beta would be given. Alongside the equity beta and financial structure of a proxy company in the industry that company is planning to invest will also be given. The aim is to remove the financial risk from the proxy company and obtain business risk alone, which is the asset beta. Then add the financial risk of the investing company to find the new equity beta, and using this, find KE applying in CAPM formula. Step 1. De-gear the equity beta of proxy company using its equity and debt values to find asset beta representing only the business risk. Step 2. Re-gear the asset beta using investing company's equity and debt values to find the new equity beta representing both business risk and financial risk. Step 3. Use CAPM formula with equity beta found in Step 2 and find the cost of equity. Formula for re-gearing and de-gearing. Beta A is equal to beta E multiplied by VE divided by VE plus VD multiplied by 1 minus T, where beta A is equal to asset beta, beta E is equal to equity beta, VE is equal to value of equity, VD is equal to value of debt, T is equal to tax rate. Example question. ABC Companies is a car manufacturer whose equity debt ratio is 7:1. The corporate debt, which is assumed to be risk-free, has a gross redemption yield of 10%. The beta value of the company's equity is 1.3. The average return on the stock market is 15%. The corporation tax rate is 30%. The company is considering a music system manufacturing project. B company is a music system manufacturing company. It has an equity beta of 1.8 and an equity debt ratio of 3:1. ABC Companies maintains its existing capital structure. After the implementation of the new project, find the cost of equity. Answer. Step 1. De-gear the proxy company's equity beta to find the asset beta. Equity debt ratio is equal to 3:1. Equity beta is equal to 1.8. Beta A is equal to beta E multiplied by VE divided by VE plus VD multiplied by 1 minus T. Beta A is equal to 1.8 multiplied by 3 divided by 3 plus 1 multiplied by 1 minus 0.3. Beta A is equal to 1.76. Step 2. Re-gear the asset beta to find the new equity beta using ABC Company's values. Equity debt ratio is equal to 7:1. Asset beta is equal to 1.76. Beta A is equal to beta E multiplied by VE divided by VE plus VD multiplied by 1 minus T. 1.76 is equal to beta E multiplied by 7 divided by 7 plus 1 multiplied by 1 minus 0.3. Beta E is equal to 1.93. Step 3. CAPM. RF is equal to 10%. RM is equal to 15%. Beta E is equal to 1.93. KE is equal to RF plus beta E multiplied by RM minus RF. KE is equal to 10 plus 1.93 multiplied by 15 minus 10. KE is equal to 19.65%. The figures used here are only for illustration purpose. Calculations related to beta application in project appraisal is important for ACCA exam.